What's up, amazing traders? Welcome back to the YouTube channel. I know I've been away for some time now. I've been very busy, and I really apologize for that, right? This is your one and only most annoying forex trader, VFX here. All right. And please, if you are new to this channel, do me a favor by subscribing to the YouTube channel, and please hit the notification bell so that whenever I drop a video you will be notified. All right, and for the returning subscribers, I want to say a very big thank you. All right, so guys, like I promised on Twitter that I will be creating a video on top down analysis, right? And actually I'm going to be doing this video in series, because if I should do it in one video it's going to take a lot of time, right? Like it's not going to be like 30 minute video, or um let me say 30 minutes to 1 hour video though. Yeah, so I'm going to be breaking it in series, right? Series 1, series 2, series 3, series 4, till we get to the final series. All right, so if this content interests you, like I say, do me a favor by hitting that subscribe button. All right, so without wasting much of our time, let's dive into the charts. All right, so now you will agree with me that the market don't just move like that, right? But before you can be able to trade effectively, you must apply what we call the top-down analysis. Now, what is top-down analysis? Top-down analysis simply means going to the higher time frame, building your story from the higher time frame, and then scale it down to the lower time frame. I understand. So, and you understand, once you start building your story from the higher time frame through top-down analysis, you can be able to trade effectively to the market direction. All right, you will know where the market is probably heading to. All right, so now you, and before we start diving into technical analysis and other stuff, sorry, before we start diving into top down analysis and other stuff, right? You need to understand the three phases of the market, which is very important, right? Now you agree with me that market moves in series of higher high, higher low, right? Higher high, higher low, right? And then higher high, higher low, and then higher high, higher low, like that, right? You agree with me that this is one phase of the market, right? Another phase of the market is the flip side of this, right? Which is the which is the which is the lower low, right? Lower high, lower low, right? Lower high, lower low, lower high, lower low, and then like that, right? And then the last phase of the market is what we call the ranging market. It's also known as the consolidation market, or the sideway market, right? Which moves in just one way, right? It doesn't go up, it doesn't come down. So it just moves at the side, right? That's why it's called sideway market, right? Now, there's something we need to understand, right? You can do your top-down analysis from the 1 month time frame, from the 1 week time frame, from the 1 day time frame, right? Those are the three most important time frame to focus on when you want to do top-down analysis. For swing traders, you can focus on 1 month time frame, right, and the 1 week time frame. For day trader, you can focus on the 1 week time frame and then the 1 day time frame. All right, you build your story from there. All right, so like I say, this video is going to be in series, right? It's going to be a series in the sense that I really want us to understand what this top down really mean. All right, so and I don't want to bore you with a very long video. All right, I want to keep it as short as possible. All right, so you can be able to understand every bit of it. So now, when you are doing top down analysis, let's imagine that we are starting from the 1 week time frame, right? And then the market is in an uptrend just like this, right? It's in an uptrend just like this. Now, in this market, we can see it's creating series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, right? What you want to take note of on the higher time frame, which is the 1 week, all right, is the swing point, right? What are swing points? Swing points are basically the turning point of the market, all right? I hope you are with your pen and jotter, right, to note some important things down, right? Swing points are the turning point of the market, the turning place of the market, right? Here we have a swing point, right? And then here we have another swing point, right? That is swing point simply when the market is going up and then it swings down and then it swings up and then it swings down and then it swings up, right? So all those places we are seeing now are now the swing point of the market, right? Right. And these are the swing point of the market. So this is what you want to pay attention to on the higher time frame, so that whenever you get to the lower time frame, you can be able to tell, or you can be able to project where the market is potentially going to. So what you do now is to mark out your higher time frame, right? Your higher time frame swing point. All right. That is, if the market is trending up, you mark out your higher time frame swing point. So this is the swing point high, right? Swing high, right? Sorry guys, swing high, right? So this is a swing high, and then here we have our swing low, right? Now in the, not in this series though, on the next series, right, I will still teach us how this swing low works, right? How they works, right? So we are not there for now, so let me delete it. So now look at our swing high, right, which at this point of the market, this high turning point of the market. So now this is what you basically need to do when you come to the higher time frame. You don't need a lot of work there. All right, once you identify your swing high, all right, and possibly you can still draw out your swing low, right? So you don't get yourself confused, right? Your swing low, right? This is our swing low in the market, right? So now whenever you see that, okay, the market breaks a particular swing high, right, and then some point in time the market starts retracing back, you will know that, okay, this market is creating a corrective move. Right now, remember I said the market moves in higher high, higher low. That is one phase of the market. Higher high, higher low, higher high, higher low. It can also be called impulsive corrective, impulsive corrective, impulsive corrective, impulsive, right? So in case you see me or you hear me, sorry, in case you hear me using word like impulsive corrective, it's still the same thing as higher high, higher low, or lower high, lower low. Impulsive move is when the market moves to the original direction of the trend, right? Then retracement is when the market move opposite direction, or opposite direction, yes, is when the market moves opposite to the direction of the trend, right? When the market moves opposite to the direction of the trend, that is what we call a retracement, right, or a corrective move, right? Please, if you are with your pen, note all these things down. You'll be very, there will be, like, it will be very, very important for you. All right, so I'm trying as much as possible to keep it very simple, not complicated. So now this is our swing high, right? This is our swing high, and then the market broke this swing high. Now the market will now make a corrective move to the downside. Now making that corrective move, that means the market has already created another swing high, right? That is on the higher time frame. We are still on 1 week time frame, right? And then the market will take it back again and then creating a swing low here, right? Then create another swing high here and then comes down, create another swing low. So once you get to the higher time frame, you want to identify those swing high and swing low, right? Once you get to the market, you want to identify those swing high and swing low, all right, to the direction of the market. So once you can identify that, you have made your lower time frame much more easier for you. All right, and when we come to this point, you can see the market creating series of lower low, lower high, lower low, lower high, right? You can see the market, right? There's a swing point here, right? And then we have another swing point around here, right? We have another swing point around here, right? Swing low, swing high. That's on the downtrend formation, right? Swing low, and then we have this swing high here, and then we have this swing low here, right? So once you can identify all these things, once you can identify all the swing high and swing low, then you can be able to go to the smaller time frame to trade effectively. All right. So let me say this market was here, right? Let me just give you a tip, right? In the second video, right? Let me give you a tip of it. Let's say the market was here, right? After creating the swing high, then the market tap into a point of interest. Now, in the series, I'm going to teach you what the market normally comes here to retest. All right, so that will be in a subsequent video. All right, so let's say the market tapped into a point of interest here, right? Now, you will know this is a point of interest. So going to the smaller time frame, you will be looking for buying opportunities to the upside, right? You can go to your 1 hour, your 15 minutes, your 30 minutes, your 5 minutes, even your 1 minute. All right, that is where you now be looking for opportunities to the upside, because you know that okay, the market has tapped into a point of interest and there's high probability that the market is likely to continue its original trend, right? Same thing applies to the downtrend formation. So once you come on your chart, you want to identify swing high and swing low. Now for the ranging market, right? The market only moves sideways like this, right? It doesn't go up, doesn't come down. It only moves sideways, bouncing off one side and then bouncing off from one side and then bouncing to another place, right? Creating generating liquidity around here. But that's we're not going to talk about liquidity on this series, right? In the subsequent series, I'll break down liquidity for you to understand how it works. All right, so this is what I want you to get in this video. Now I'm going to give you an assignment. Go to your chart, right? Try as many pairs as possible as you can. Identify swing points in the market. Identify those major swing points on the 1 month, on the 1 week, on the daily. All right. Once you can be able to identify it, right, you have made your smaller time frame much more easier for you. All right, so I want you guys to master this first, right? So this particular series first. I don't want the video to be too long. All right, so in the next video we are going to be moving deeper, all right, on top down analysis. So always remember, this video is telling you that on the higher time frame, what you're supposed to be concerned about is the swing point of the market. All right, swing point of the market. Once you can be able to identify that, then on the smaller time frame, we can now go deeper. All right, so that is my assignment for you, and then I will catch you in the next video. And like I say, if you're new to this channel, please subscribe to the YouTube channel, right, and hit that notification bell so that whenever I drop the next series, you will be notified. It's your one and only most annoying forex trader in the industry. Yes, and I really love you guys. Right, see you in the next video.